Hello, my name is Harold Bennett. I am 72 years old. For nearly 40 years, I taught mathematics at a public high school. I spent my life explaining patterns to young minds: algebra, probability, statistics, calculus. I taught them that numbers never lie, but people often misunderstand them. I have lived long enough to see the world change more times than I can count. I remember when telephones were attached to walls. I remember when computers filled entire rooms. I remember when the internet was something mysterious and slow. And now I live in a world where money itself has become digital. When I first heard about cryptocurrency, I did not laugh at it. I studied it. Because when something challenges the structure of global finance, you do not dismiss it. You observe it carefully. You look for patterns. And that is what I have been doing for years now, observing. People often ask me, "At your age, why are you interested in crypto?" And I tell them something very simple. Because crypto is mathematics meeting human emotion. And that combination is fascinating. Today, I want to talk to you honestly. Not as a trader, not as a promoter, not as someone promising wealth, but as an old teacher who has watched financial cycles repeat themselves for decades. Crypto crashes, crypto rises. It terrifies people. It excites people. But it does not move randomly. It moves according to forces that are older than cryptocurrency itself. To understand when crypto crashes and when it rises, you must first understand human nature. When I was teaching probability, I would often tell my students something important. Humans are not rational creatures. We are emotional creatures who try to justify our emotions with logic. Financial markets are simply large groups of humans making emotional decisions at the same time. Let me take you back in time. In 2008, the global financial system experienced a severe crisis. Trust in banks weakened. Governments intervened. Confidence shook. Around that same period, a new idea appeared quietly on the internet: digital money without central control. It was revolutionary. At first, almost nobody cared. But over time, something interesting happened. Scarcity met curiosity. Bitcoin had a fixed supply. That idea alone attracted early believers. They were exploring possibility. Early belief transforms into optimism. Optimism transforms into excitement. Excitement transforms into greed. And greed is where danger quietly enters. I saw it during the dot-com bubble. Companies with no profits were valued in billions. When price moves faster than adoption, the system becomes unstable. Crypto is no different. When taxi drivers start discussing tokens and students trade with borrowed money, you know we are entering dangerous territory. When financial conversations become casual entertainment, leverage allows traders to control large positions with small capital. But leverage is fragile. When price moves slightly against a leveraged position, exchanges automatically liquidate it. Now let's talk about liquidity. When interest rates rise, capital becomes expensive. Risk appetite shrinks. And crypto often falls hardest because it is considered high risk. A crash does not mean failure. In fact, crashes are often necessary. They remove excess. After every major crash, something interesting happens: silence. But beneath that silence, builders continue building. Developers refine code. This phase is boring, but it is powerful. When sellers are exhausted, supply tightens. Fear spreads faster than optimism, but fear has a limit. At some point, everyone who is going to panic has already sold. And that is where recovery begins. Crypto will crash again. Crypto will rise again. This is not pessimism. It is pattern recognition. And if you can recognize the pattern, you no longer fear the cycle, you respect it. Preparation leads to survival, and survival over time leads to opportunity. This is only the beginning of the story. When I first began studying cryptocurrency seriously, I did not start with excitement. I started with questions. What gives it value? Why does it rise so fast? Why does it crash so violently? And why do people keep coming back to it even after losing everything? The more I researched, the more I realized something important. Crypto is not just technology, it is psychology, it is economics, it is human emotion compressed into numbers. You see, when people talk about crypto going up or down, they usually blame one single thing. But markets never move for only one reason. They move because of layers. Let me explain those layers the way I understand them. The first layer is belief. Every financial system is built on belief. The dollar works because people believe in the government behind it. Gold has value because humanity agreed it does. Bitcoin has value because people believe it represents digital scarcity. When belief grows, prices rise. When belief cracks, prices fall. That is the foundation. Now comes the second layer, liquidity. Liquidity simply means how much money is flowing into the system. When central banks print money and interest rates are low, investors look for higher returns. They move into stocks, tech, and yes, crypto. That is why in 2020 and 2021, when stimulus money flooded the world, crypto experienced one of the biggest bull runs in history. But when inflation rose and interest rates increased, liquidity dried up and crypto fell. Not because it died, but because money moved elsewhere. The third layer is fear and greed. Markets are emotional machines. When prices rise quickly, greed takes control. People who once doubted suddenly become believers. They do not want to miss out. They buy late, they buy high. And when prices drop even slightly, fear replaces greed. They panic, they sell. And that selling pushes prices down even further. This is called a cycle. And crypto cycles are more extreme than traditional markets. Why? Because it is still young. But here is something most people do not understand. Every crash in crypto history has eventually been followed by recovery. After the early Bitcoin crashes, after the 2017 bubble, after the 2022 collapse, each time people declared it dead, and each time it survived. That tells me something. Not that it is guaranteed to succeed forever, but that it has resilience. Now let us talk about when crypto goes up. Crypto rises when three main forces align. First, positive narrative. If there is news about adoption, ETFs, regulation clarity, or technological upgrades, confidence increases. Second, liquidity expansion. When central banks ease policies and money becomes cheaper, risk assets rise. Third, reduce supply pressure. For example, Bitcoin halving events reduce the rate at which new coins enter circulation. Less supply, same or higher demand, price increases. This is simple economics, supply and demand. But there is another factor I observe carefully: time. Crypto moves in cycles of accumulation, expansion, euphoria, and correction. In accumulation, prices are boring. Nobody talks about it. Media ignores it. That is when long-term investors quietly buy. In expansion, price starts rising steadily. More attention comes. In euphoria, everyone talks about it. Taxi drivers discuss coins. Friends who never invested before suddenly become experts. That is usually near the top. And then comes correction. Sharp, painful, necessary. The weak hands leave. The market resets, and the cycle begins again. Now, as an older man who has seen multiple economic cycles, dot-com bubble, housing crash, stock market panics, I do not view crypto as magic, nor do I view it as evil. I view it as a high volatility asset driven by innovation and human emotion. It crashes when leverage becomes excessive. It rises when confidence and liquidity return. It crashes when fraud and overspeculation dominate headlines. It rises when infrastructure strengthens. It crashes when interest rates rise sharply. It rises when monetary policy loosens. But here is the deeper truth. Crypto does not move randomly. It reacts to policy, to technology, to regulation, to global fear, and to human psychology. If someone asks me, should I buy crypto? I do not answer yes or no. I ask them instead, do you understand the volatility? Can you survive a 50% drop without panic? Are you investing with logic or emotion? Because crypto rewards patience, but it punishes greed. Successful investors in this space do not chase hype. They study cycles, they manage risk, they diversify, and most importantly, they accept uncertainty. I am 72. I do not trade daily. I do not gamble, but I observe. And what I see is not chaos. I see rhythm, like seasons. Winter feels permanent, but spring always returns. That does not mean every coin survives. Many disappear. Innovation eliminates the weak, but strong networks with real use cases tend to endure. So when does crypto crash? When excess meets reality, when leverage meets tightening liquidity, when euphoria forgets fundamentals. And when does crypto rise? When innovation meets adoption, when liquidity expands, when fear turns into cautious optimism. If you remove emotion, crypto becomes easier to understand, not easy to predict perfectly, but easier to interpret. And that is how I approach it. Not with excitement, not with fear, but with curiosity, because markets are teachers, and at my age I am still a student.